In Chapter 8, we get to talk about risk and rates of return. The major objectives for this chapter are for you to be able to explain the difference between standalone risk and risk in a portfolio context, to describe how risk aversion affects a stock's required rate of return. We will discuss the difference between diversifiable risk and market risk and explain how each type of risk affects well-diversified investors. We will describe what the CAPM is and illustrate how it can be used to estimate a stock's required rate of return. We'll also discuss how changes in the general stock and bond markets could lead to changes in the required rate of return on a firm's stock. And then finally, we'll discuss how changes in a firm's operations might lead to changes in the required rate of return on the firm's stock. So there are two types of investment risk: standalone risk and portfolio risk. Standalone risk is just the risk of holding a stock by itself. So the risk of holding one single stock is much more risky than holding multiple stocks in a portfolio. So standalone risk is much higher, and then portfolio risk is just the risk that you face by having a portfolio of stocks. In other words, portfolio risk is the chance that the combination of assets within an individual group of investments fail to meet financial objectives. And in theory, portfolio risk can be eliminated by successful diversification. When we talk about risky investments or investment risk, we're talking about the risk of losing money or getting a negative return. And the higher the expected return for a stock, usually the riskier that stock is. The lower the expected return, usually the lower the risk is for that particular stock. So here's just an example, this should remind you of statistics, of different probability distributions. So we have firm Y and firm X. Firm X has a lower standard deviation because it has a shorter graph. They both have the same expected rate of return of 15%, but firm Y has a larger standard deviation than firm X. So for firm Y, there's a possibility that you could earn much more negative returns than you could for firm X, since its graph only goes down to this level of negative returns. Now, on the upside, firm Y also has a possibility of earning much larger returns than firm X. So, in general, when you're trying to invest, you want to combine like firm Y and firm X and all these other firms together, and you can hopefully shoot for an expected rate of return of about 8% and have a lower standard deviation than either of these two stocks held individually. Some of the returns from 1926 to 2012 are just listed here for an example. So the riskiest stocks are the small company stocks, and you can see they have the highest average return, but they also have the highest average standard deviation. And then you go down to large company stocks, and then long-term bonds, the corporate bonds, and then long-term government bonds, and then U.S. Treasury bills. And you can see that these are the riskiest at the top, small company stocks, going down to the least risky, which are U.S. Treasury bills. So just because something offers a greater rate of return doesn't mean it's a better investment, because it also probably has a much greater level of risk. And now we have this huge data load here, and we've got probabilities for the economy. The probability of being in a recession is 10%. An average economy, the probability is 40%, all the way to an economic boom, which is probability of 10%. And then you get these different companies. Well, Treasury bills are going to remain constant. They're offering 5.5% no matter what the state of the economy is, because a Treasury or the government is always going to pay the Treasury bill. And then we have these three companies. HT stands for High Tech Inc., and it's an electronics firm. COLL is for Collections Inc., and it collects past due debts. And then USR stands for US Rubber, and it manufactures tires and various other rubber and plastic products. And then MP is for the market portfolio. So you see what their expected returns are in each of these types of states of the economy. So if we have an average state of the economy, we expect this line of returns. So we're going to use this data all throughout the next several slides. So here we have a question, why is the T-bill return independent of the economy? And that's because the Treasury bill return of 5.5% does not depend on the state of the economy, because the Treasury must and will redeem the bills at par regardless of the state of the economy. The Treasury bills are risk-free in the default sense because the 5.5% return will be realized in all possible economic states. However, remember that this return is composed of the real risk-free rate, say 3%, plus an inflation premium, let's say 2.5%, and that sums to be 5.5%. Since there is uncertainty about inflation, it is unlikely that the realized real rate of return would equal the expected 3%. For example, if inflation averaged 3.5% over the year, then the realized real return that you get would only be 5.5% minus 3.5%, which equals 2%, and not your expected 3% that we just said. Thus, in terms of the purchasing power, Treasury bills are not riskless. Also, if you invested in a portfolio of T-bills and rates then went down, your nominal income would fall. That is, that Treasury bills are exposed to reinvestment risk. So we can really conclude that there are no truly risk-free securities in the United States. If the Treasury sold inflation-indexed tax-exempt bonds, they would be truly riskless, but all actual securities are exposed to some type of risk. Now, if you notice back on the previous slide, high tech versus the collections company moved differently with the economy. High tech moved with the economy. When the economy was doing well, high tech also did well. When the economy did poorly, high tech also did poorly in terms of its expected return. However, collections is considered by many investors to be a hedge against both bad times and high inflation. So if the stock market crashes, investors in this stock would do really well. So stocks such as collections are negatively correlated, and that means they move counter to the economy. And if you noticed on that previous slide, when the economy did well, collections did poorly. But if the economy did badly, then collections did well. And then in real life, it is almost impossible to find stocks that are expected to move counter to the economy like we have in this example.